This isn't going to be all about taxes, but it's going to be for all of you real estate investors specifically, and something that not many people seem to know about, but something that's been around for a long time that you have not been told about.
Bottom line, if you've got income tax liability, cost seg can help wipe it out.
If you haven't done a cost seg and you're bitching about not, wanting to pay as much in taxes as you are, this is the solution. What's going on, everybody? Chris Naugle back with the Money School podcast. This show is all about, well, you guessed it, money, but more specifically about you taking back control of your money by you becoming your own bank. And we talk about all topics money, and today's episode is going to be exactly that. But not just how to make money, it's more how not to give money away in taxes. That's right. This isn't going to be all about taxes, but it's going to be for all of you real estate investors specifically, and something that not many people seem to know about, but something that's been around for a long time that you have not been told about. How do I know this? I was that guy. And I had tax issues. I didn't want to pay as much in taxes. And I'm sure all of you want that same thing, right? You want to pay less in taxes, hold on, legally. Because you don't want that black, you want to be black and white, not gray. So legally. And when I had this situation, I was in real estate and I didn't know anything about this. That is exactly how I met today's guest, Jeff. He was in, I don't know how he came into my life, but he was probably introduced by somebody that I knew well. And he solved a really big problem for me at that time. And since then, he has solved problems for lots of our clients, but let's just dive right into it. My guest is Jeff Hyatt. The name of his company, MSC Cost Segregation Consultants. Now, you probably know just from the name, if you know, cost segregation. That's what we're going to be talking about. And I always thought cost segregation studies were for the big buildings, the big commercial properties. But you know what? I've actually learned it can work for your Airbnb. It can work for your single family rental. It can work for your duplex, quad. It can work for all of your real estate. And it absolutely will save you money in taxes. But I'm not the expert in this. I'm just the consumer of the cost segregation studies, if you will. So my guest, Jeff Hyatt, is going to tell you all about this. Welcome to the show, Jeff.
Oh, I'm psyched to be here. Chris, you've got a great program going. I loved being part of your Private Money Club event down in Dallas a couple of weeks ago. It was awesome. So thank you for that. Met a lot of great people, and they're all, focused on real estate growth and investing and all of that. So it was fantastic. So thank you for having me there. Thank you for having me here today. I'm psyched to be here. And like you said, our service is largely underutilized. So few people out there. Only about 30% of the folks that could take advantage of cost seg actually do. And it's mind-boggling to me that I've been doing this. Our firm has been doing this since 96. I've been doing it with the firm since 99. So many of your folks hearing this and seeing this interview probably weren't even born then, or maybe they were still in diapers then. But it's crazy to think about that this great tax tool out there that could save people lots of money of income tax is just not talked about, which I find it freaks me out every day. But I'm thrilled because it gives us an opportunity to deliver great results for our clients.
Absolutely. Now, let me kind of get this kicked off with just a little story. So we're going to go all the way back to right around, I might get this wrong, but literally 2008, 2009 timeframe. I was developing a strip mall right when the Great Recession kicked in, and the Great Recession hit, almost drove me to bankruptcy. But nonetheless, because of some things that I did, my girlfriend at the time, who's now my wife, helping me pay the bills, some friends moving into my house. I mean, listen, when your back's against the wall, you just do what's necessary, right? I think we can all agree on that. But I still pushed through and I finished that strip mall. And that strip mall was going to be the new home for my retail store called Fat Man Board Shops. It was a skateboard, snowboard shop. My whole goal was to stop paying the man, if you will. I was leasing a space. They just increased my rent significantly, and I was just done with not being in control. So there was a paint store that I bought 2 buildings down, and I embarked on my very first development project, which I learned a lot. But when that thing got done, it was cash flow positive. And once it was cash flow positive, well, at that point in time, I had sold off a lot of my real estate assets because of the Great Recession. I needed the money. So when I sold them off, I had tax bills, big tax bills. And I met Jeff through somebody that referred me to him. And he said, hey, I can help you with those tax bills, which is exactly what you're going to learn about today with cost segregation studies. Now, I know a lot of people, when they hear this, are going to be like, well, what's it cost? Well, hold on. Let me flip the script. Let me just use a recent example of an Airbnb. It's actually just a ski chalet that we own. Okay. And we rent it out. And that ski chalet, let me just ask you this. Would you pay roughly $5,000 if you got a $50,000+ tax deduction? Let's just be real. You're gonna have a tax deduction of over $50,000, but the cost is $5,000. How many of you would not take that deal? Put it in the comments. It's crickets. All of you would do that. You'd pay $5,000 to get $50,000 in tax deductions, but yet so many people put the cart in front of the horse when it comes to this. They're like, what's the cost? What's the cost? What's the cost? Stop asking what something costs, because cost is only an issue in the absence of value. The value in that particular case was 50,000+ in tax deductions, which you don't need to be good at math to understand. That's a pretty freaking good deal. So, Jeff, let me turn it back over to you and just have you talk a little bit about what is a cost segregation study and how does it actually save you money in taxes when you do this?
It's great lead in. And that's the conversation I have every day with clients. We've been as I mentioned, since 96, we've done about 26,000 of these. And like you said, Chris, everything from little Airbnb properties to skyscraper buildings all over the country. But the bottom line is, whether it's a small little Airbnb or a single family rental or a big building, any way, shape, or form, the IRS says, the tax code says, you have to write that building off over either 39 years or 27 and a half years. It's one or the other. It's for an apartment building, let's say a residential rental, it's 27 and a half years. Anything else out there is 39. Okay, so you've got the situation that it's either a long life at 27 and a half or 39 year. But the tax code also allows for you to take pieces of the building that are not structural, and you get to write them off more quickly. So the IRS says a building to be a building, the structural components are going to be the walls, the windows, the doors, the roof, the HVAC, the plumbing for a bathroom, and electrical for lighting. Other than that, it's not going to be 39 year or 27 and a half. So if you think about it, the items that are going to go into the faster life are in the 15-year category are when you drive onto the property. So as soon as you get on the property, the driveway, the fence, the gates, possibly a mailbox or possibly site lighting, whether it's, big poles like 20-foot poles or a little, light that lights the sidewalk for the front walk. It's going to be railings. It's going to be decks. It's going to be swimming pools. It's going to be all kinds of stuff. Anything outside of the building to the property line that people put in place, you get to take a faster write-off on. That's 15-year. And then the 5-year stuff are the items inside that could be things like, you go to the basics like the flooring. Well, you've got engineered flooring, LVT, you might have carpet, you've got decorative trim and cabinetry and things like that. All of those items, you end up in a situation where the reallocation is going to be somewhere between, on the low end, 15% to 25% that you can pull into a faster life. And by pulling that into a faster life, that gives you the deduction. And the really beautiful thing is that now with bonus depreciation looking like it's coming back in at 100%, life is very good. And all of a sudden, you've got a great outcome for almost any property on that your clients or your viewers have bought, built, or improved in the last 10 or 12 years. I say that 10 or 12 year scenario because you can step back. So, Chris, even if you hadn't already done the cost seg, you can step back in time without amending your tax return and grab that depreciation deduction
Wow.
in the current year to wipe out taxes now.
Let me just hit one thing there. With you said something that I heard and I want to clarify for the audience. Without amending your tax return?
Correct. So the IRS, usually somebody would go, and oftentimes CPAs not familiar with my space would say, "Oh, Chris, you can't. You bought that back in 2015. You can't do anything about it. The amending time frame is only the open years, which is typically the last 3 years. So you bought that in 15. That doesn't help you, bud. You're out of luck." Well, you don't have to amend. The IRS has a different provision for cost segregation, and they call it a change in accounting method. And so one of the things that our firm does, because we have so many accountant type folks on staff, is we complete this form called a change in accounting method form that the client can put into their tax return. The beauty of that form is you don't have to amend. You can go back technically to 87 when the tax laws changed, but typically you don't go back that far. Usually it's 10 to 12, 10 to 15 years, somewhere in there, where it will make sense financially to do the cost seg. But the bottom line is you don't have to amend. You get all of the deductions you could have taken in the past in the current year against current income tax. And that if you have excess, it will automatically carry forward in what they call a loss carry forward.
So I'm just going to spin this to be all about me for just a second, because I've got, I don't have a lot of rentals anymore, but I've got two duplexes in Buffalo that I've never done a cost segregation study on. I've got another one here in Clarence, which is just a single family rental, but it's got a huge property and it's a big house. Then I've got another one out in Lockport, which is a really small kind of lower end house. And then, and I think I talked to you about this one. I've got my office building and all the studios back here. And there is a lot of that stuff that you said we could take bonus depreciation. And I'm looking around here and I'm like, bonus depreciate. Yep, those two, lots of lights in here that could get bonus depreciated. And then I've never done it on this one, but we're going through a refinance right now on this property because we had somebody that we needed to get rid of. And I didn't want to do it with that person part of it. So they'll be done. And then I need to roll this in. So now I can take and hire your firm to do cost segregation studies on all of those properties and take those deductions this year, which I desperately need.
Yes, absolutely. I mean, I'll point it out by looking, in your background there. You've got the wall there with the fire.
A lot of people think this is fake. So this wall?
Yeah, that wall right there. And and the fireplace would go into a faster life. That's obviously decorative. You've got the wall material, the wood planks. You've got it looks like sheet metal there. You've got the wall board, the trim around that. You've got fancy colored lighting. You've got the BYOB man there and the wiring. So keep in mind, it's not just the signage, but there's probably a wire behind that.
Oh, there's lots of wires.
Yeah, lots of wires. Wires are good for a cost seg. And it looks like there might be some carpet there. It looks like you have a decorative chandelier hanging above you. So that would, not only the chandelier, but then the wiring for the chandelier would help you there. So all of that stuff would go into the faster life, giving you a benefit retroactively.
Now, what if I affixed this 1987 GT Pro Freestyle Tour BMX bike to the wall?
Well, you'd probably end up being in a situation that's a little aggressive, but you may have already written off that vintage cool bike. But if you hadn't and it became a wall decoration, then maybe it would go into the 5-year category. But
I certainly have not written that bike off yet.
You have not. Okay. Well, then we could talk about that for sure.
Awesome. Love it. Love it. Love it.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club is for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
All right, so let's keep going and just kind of go a little deeper into some of like the mechanics of how this works. So someone like myself has this building or these buildings, and some of the buildings are old because I wasn't told about this. Actually, hold on, let's put a pin in that for a second. Why wasn't I told about all of this cost segregation study with all my other CPAs that I've had? Now, my current CPA clearly knows about this, but he's more of, I pay him a retainer to be a tax planner, not a CPA. I've never had any CPA in the last 15 years, maybe even 20 years, I'm trying to do the math, that has ever even mentioned cost segregation studies. When I just told you I've got all those properties and I had more, and I took no cost, I did no cost segregation studies on any of the other properties. So why am I not told about this?
And you're not alone. As I think I mentioned earlier, only about 30% of the people that could take advantage of cost seg have actually heard about it. And if they have heard about it and they've asked their accountant about it, oftentimes the response is, oh my gosh, Chris, why would you want to do that? You're going to take all your depreciation early and then you're not going to have any depreciation later. Why, Chris, why would you want to do that? Well, Chris, but hold on, you're not taking it all. Remember, I said you might have 75% to 85% still in the long life. So you're still going to have 75 to 85% of your depreciation. We're only front end loading 15 to 25%. The balance stays in the long life. The balance is still allowing you deductions in the future. So it's a misnomer or it's misinformation if an accountant says, oh, you're not going to have any depreciation later. The reason you might not do it is if you said, hey, Jeff, I'm buying this office building. We're putting in we bought it this year. And later this year, after we put in these nice studios and all, we're going to sell it for a profit. Well, then you probably wouldn't do it because the recapture bite is going to come back and you're going to have to give back all the tax benefit we just gave to you. So that probably wouldn't make sense if you're going to only hold the property for a year or two. But if you're going to hold it longer than that or you're going to do a 1031, which is probably a topic for another one of your seminars here, podcasts. But if you're going to do a 1031 and you're only going to hold it a short amount of time, then it's back, cost seg is back into play for you. If you're not paying income tax and you've mentioned you've got some tax liability coming up or, this could still apply for tax year 24. But bottom line, if you've got income tax liability, cost seg can help wipe it out.
I love it. I literally just, as you were saying that, I'm texting one of my partners for one of the buildings saying, hey, you want some tax savings? So yeah, I love that. Love that. And I'm not going to lie. When you said that about being able to go back, I thought, I don't know why I thought this, but I thought you could only do it like when you bought a property or owned a property for a specific amount of time. And then you said that you don't need to wait. I mean, you can do it anytime you own a property and I don't need to go back and amend anything. So that was huge for me.
Well, yeah, let me know what your partner says about that. I'd like to hear his comments as well.
Absolutely.
And, there are so few people out there that hear about this from their CPAs. I think CPAs just sometimes, if they're not heavy into the real estate space, this is one of those topics that gets overlooked or brushed over, and then the client is left kind of not getting to take advantage of a big piece of the tax code that could really help them. And where they might be in short-term rental, help them even more so because it can wipe out taxes on their W-2 and 1099 if they're in short-term rental space.
Yeah, I think a lot of CPAs, and I'm not trying to talk down about any CPAs, but I think, they're just so in the routine of like it's tax time. So they're just in prepare tax returns. And it's just a law of numbers. They got to do a whole bunch of tax returns in a short amount of time. I'm sure it's incredibly stressful, even though the CPA, I preface, should know whether their client has real estate, and definitely should go one step further. Hey, have you ever thought about taking this depreciation up front if they saw that there's going to be taxes owed? But usually it's just banging returns out. I speak firsthand with that because that's how all my other CPAs seem to be. And then I would basically try to push them to do tax planning, but tax planning always came fourth quarter, no matter how much I tried pushing them. And then it was just like all at once. And then it was too late, because a lot of times it was just too late to get the cost segregation studies done for that particular tax year. So then they would push it and say, well, we'll do that next year. And like you said, they just do straight line depreciation. But for me, that just didn't really make any sense because I don't plan on keeping these properties. What was it, 27 years or 30 some years? I mean, maybe 39 years. I mean, come on. I mean, how old would I be? I mean, I'm not looking to just wait all that time to get my tax deductions if I have them. So anyway, going down a rabbit hole there, but I just think that CPA should just kind of take a little bit more time, especially with a client when they see that they have real estate, to say, hey, here's an opportunity, because nobody wants to pay more in taxes and everybody would like a larger return. So actually, how does that work? Like, I know that like if I do tax harvesting in a stock portfolio, if I sell off losers like I did last year, I had a bunch of treasury bonds that were at a loss because I'm just waiting, for those to come back up. And I sold them all at the end of the year, took that harvest, and then I rebought them in 2025. So how does that work? Let's say somebody does a cost segregation study, but that year they didn't really need all of the deductions. Can it carry forward?
It absolutely can. There's a thing or a provision within the tax code that says, if especially related to this, if the client gets more deductions than they need in a given year, the cost seg deductions will flow over to the following year and the following year. So it's like you're going into the next year. In this case, you would be going into tax year 25 or tax year 26 with some deductions already in your back pocket. And as soon as you get into that tax year, bam, your accountant can play those cards, those deductions in your back pocket, and get the tax benefit from it in that coming year. So it's a beautiful thing that we oftentimes have clients who will do one of two things. They may have a portfolio of, say, 10 buildings. We do all of the buildings at one time so they know what the real numbers are, because our estimates are usually conservative on what we're going to give to the client. We don't want the client to bump down their estimated tax payments, anticipating big numbers. And then if we didn't hit those numbers, they're going to be ticked off. Their accountant's going to be ticked off. We don't want that. So we'd rather give you and your listeners out there an estimate that's conservative, that we know we can hit, so that when we come back, we're giving them great news, because not only did we hit our number, we actually did X percent more. But where I'm going with that is, if you did a portfolio of 10, then you can decide, do I just dump them all in at once and have that loss carry forward going forward for 4 or 5 or 6 years? Or do I pay them in, and I'm going to use property 1, 3, and 5 this year to most accurately knock down my tax bite, and then properties 2, 4, 6, and 8 the following year. So you can, on a portfolio type situation, you can go ahead and maneuver as to how you and your accountant see best to go around the tax situation there.
And there's one thing, that I want the audience to kind of, take out of what you just said is you're able to do an estimate, and you go on the conservative side. So usually you're trying to come in a little lower than where it's going to be, but you give an estimate. So we're going into, holy cow, almost third quarter.
Well, yeah. Yeah.
Oh my gosh, I don't know where time goes. Sorry, that just hit me like a freaking wrecking ball. As a holy cow, it's almost third quarter. But nonetheless, we're going into the third quarter, and like if you're doing some tax planning, you can get an estimate for if you're going into this cost segregation study, and you can call your CPA and say, hey, listen, I'm doing cost segs. Here are the estimates, and then that CPA can kind of work that into your tax planning, and that can make a huge difference. I know for me, like I know what my taxes are going to be this year already because I've got somebody who does tax planning. So now when I look at these other properties that I've got, you can give me these estimates. I feed those to my CPA. My CPA adjusts all my numbers, which literally could, I'm not going to say this because I'm not a CPA and I can't give tax advice, but could reduce the estimates that I have to give to the IRS and the state. Because I live in that really beautiful state called New York, and we get destroyed in state taxes. Like my CPA, when I first met him, Jeff, he said to me, he says, he's like, I got some really good advice for you. And I'm like, all right, nobody's ever given me great advice this early on. And he says, move out of New York State. You'll save yourself a couple $100,000. I'm like, damn. I'm like, Mark, that's not the advice I needed because I can't move out of this state. He's like, I'm just telling you. He said, move out of the state. And I just saved you a couple $100,000 in state taxes. I'm like, yeah, about that. But nonetheless, I have to go, to people like yourself and MSC, to do these cost seg studies because I can't move out of this beautiful, beautiful state of New York.
It is a great state, the great state of New York, the Empire State, right?
Sure.
So, but yeah, that's what you can do is use the estimates that we're giving. And like you said, potentially your CPA can adjust estimated tax payments as they come along, potentially. On that note, this would enable you either, because some folks are still on extension for tax year 24 in this case.
I am.
So, yeah. So if you have a tax bite coming up for tax year 24, you could still do the cost seg here in 25, grab the deductions and apply them for tax year 24.
I never thought about that, actually.
And then, and if you don't have enough tax liability to worry about, then you don't worry about it. You just use them for 25. But the beauty of it is you could use it for 24 or 25 or all of the above and even into 26, depending on, how much we're able to carve out of the various properties you've mentioned.
I don't know why, I guess just people like myself who aren't in the business and really kind of, we just have professionals working taxes. Like it literally never dawned on me that I could use this toward 2024, which I have a big tax liability. I guess I'll disclose this. My tax bill, state and federal for 2024 was over $1 million. So I already paid all of that. Like I had to pay all that in estimates when we went on extension and before the end of the year. So I could maybe claw some of that back if we do these cost segs on some of these properties.
Correct. And oftentimes, as opposed to getting back, let's say a refund, people will just let that sit because it's already kind of out of your world, but they just wouldn't be paying income tax because you've got it sitting, let's say, at the IRS in the Department of Treasury for a while. So it depends on your own situation and what your accountant suggests that you do there. But that could work really nicely. And on that note, going back to how you and I, kind of work together at your private money club event, this can really help folks do, dump-ins to their be your own bank situation where if you gave somebody 50 grand that was going to go into a tax payment and now, or it's 100 grand or it's 500 grand, whatever the numbers are, they can use that to pre-fund some of those policies that you put in place for them.
Yeah, dump-in deposits. Yeah, heck yeah. I mean,
it's basically
you don't have to give it to the government. It's money. Here's how I look at taxes, Jeff. I look at taxes as it's money that's not mine to get, from the get-go. So when I look at, my foundation contributions, my oil investments, my solar tax credits, like all of those are being funded with money in my mind is not my money. It belongs to the IRS, but I'm going to put it into these different things because I don't feel the government does a very good job of managing money. So I'd prefer to give them less money to manage than I keep. And by doing these different things, it's just money that, wasn't mine. And a lot of people get really hung up on that because like, it's my money, I earned it. No, actually it wasn't. You earned it, but then there's that 40 or 30 or 28%, whatever your tax bracket is, money that is not yours. So just do the calculation. What do you think you're going to make this year? Figure out your estimated tax, figure and what that percentage, and then that's money that's not yours. So if you can take some of that money back, that's a freaking win. And when you take it back, now you can start your own private banking system by pre-funding the banking system with money that wasn't yours to get go. So it is kind of like free money that just shows up at the front door. And listen, I love this. I love this. So first off, folks, just so you all know, if you're interested in meeting with Jeff about cost segs, just like I'm going to be doing as soon as we're done with this, the description and all of his info will be in the description. Sorry, I said that wrong. So his information will be in the description. But Jeff, real quick, for those that are driving, and they can't write things down or can't look, can you just give them a way where they can contact you to book a call?
Sure, absolutely. So you can reach out to us. Our website is costsegs.com. So that's the simplest way is just ping that and go ahead and mention Chris. We offer a $100 fee reduction just on that. So if you're a client of Chris, just put in there Chris Naugle or something about BYOB or whatever your reference point there that we can connect it to Chris, and we'll give you that $100 off as just the start. We provide complimentary estimates and proposals for you. One of the things that we'll then send you is our quick questionnaire. It's basically 8 or 10 questions, the stuff that every property owner knows off the top of their head. And we'll give you that estimate. We'll walk through it. We'll kind of show you a before and after snapshot so that you can understand, hey, if I spend $1, how much am I saving in tax? Usually, it makes sense for clients when they've spend $1 on the study and they save at least $3 or $4 in tax. You give me $1, I save you 3 or 4. People say, "Hey, that's not a bad deal." Well, we hit that threshold at about 250 to 300,000, depending on bonus years. So somewhere in that neighborhood, if you've spent 250 to 300 grand or higher to buy your building, build your building, or renovate it, cost seg is going to make sense for you. You'll get at least that threshold of 3 or 4 to 1. And beyond that, the numbers, the ROI goes up a ton.
I love it. I love it. So folks, we'll put that up in the description. Just book a call. And hey, I didn't know he was going to allow you guys to save $100. So just drop my name, put BYOB in there and get $100 off your study. So this has been fascinating and really fantastic, but let's just kind of just walk through real quick. So I've done this, but it's been a while. Walk me through what are the steps? Like, how does this whole process work? So first I go to costsegs.com. Did I get that right?
Yep,
costsegs with an S.com. I go there, I book a call, I put my name in there because I want the $100 off. And then what happens next? We do a phone call, you get addresses. I mean, walk me through what this looks like.
So what we would do is I would have my team initially go ahead and do a quick review, and they're going to take the data points. They're going to do a quick Google Earth just to look at the building, see, what kind of shape it is in roughly. And then we're going to work up that estimate. We're going to go through the conversation. And then you say, yeah, that's great. Let's do it. So then we get the engagement letter back from you. Our team is going to coordinate a site visit because the IRS requires a real site visit. There's a lot of, I'll call snake oil salesmen out there that are saying, oh, just do a remote site visit, do a FaceTime with us or do a Zoom call. Well, the IRS, it does not allow that. And in other words, if you get audited and they come across the fact that it was done via virtual site visit, they disallow it. And so then you wasted whatever you spent on the snake oil. Bottom line is we have always done real site visits. So we'll have a qualified professional show up, go through the building. They'll go through and measure everything, that's behind you there and the fireplace and the mantles and all that stuff. And then we'll put literally a value on every single thing in your building. You're going to know the value of the accelerated items, but also the not accelerated items. Every outlet and every light switch, you're going to have a value on everything in your building. The beauty of that is it not only helps you today to reduce the taxes, but it'll help you in the future when you decide you're tearing stuff out, whether that's the roof or the windows or the HVAC. So that's why we do a real site visit. We're going to get the report back then from my team. And then the report in hand, I'm going to meet with you, Chris. I'm going to go through it and I'm going to say, hey, Chris, here's where you were. Here's what you had taken. Here's where you ended up. Hey, take a look at this. Look at the tax deferral, the tax savings you got out of this. Hey, let's go. High five. And then everything would get applied with your CPA into your tax return for that year. We would complete the 3115. That's an interesting form. It's a very complicated form. At a minimum, it's usually 8 pages. We complete those 3115s because if there's an error on those 3115s, it triggers an audit from the IRS, and nobody wants that. So we always complete the 3115s for our clients, and then it goes into your return.
How many audits we've done a lot of these. How many audits have you gone through?
So our audit rate is less than random. So random audits occur 1% of the time. We are audited less than 1% of the time.
Wow.
So, and for the most part, we come through unadjusted because there's black and there's white, and
then there's GT Pro Freestyle Tours gray.
Well, and then there's the gray. And so we might say to you in that exact example, since you re-brought that up, we might say, hey, Chris, on that one property, we're going to save you 50 grand, 100 grand, 200 grand, whatever it is. If we do the vintage bike, you're going to save maybe an extra 10 or 20 grand. Is it worth, drawing fire from the IRS if you're audited? And typically people go, it's probably not worth it. But they might go, let's go. And that's their call at that point. But
Love it. All right. So folks, hopefully that really gets you motivated to, book a call with Jeff and his team, to try to save in taxes, because you definitely have it. If you own properties, rental properties, Airbnbs, hotels, motels, giant commercial warehouses. I mean, come on. I've got clients that have giant hotels. I mean, if you haven't done a cost seg and you're bitching about not, wanting to pay as much in taxes as you are, this is the solution. So book the call, get $100 off. Just use my name or BYOB when you book the call. And with that being said, Jeff, anything you want to say in parting words?
No, Chris, thanks. I'm looking forward to doing some more properties for you. That's great. And maybe afterward, I can invite myself on we'll have a little wrap up victory lap and talk about how that results turned out for you.
That would be awesome. We'll do. Yeah. So folks, we're going to do, we'll do the cost segs on mine, and then we'll basically come back and do a round 2 episode where we talk about how much I saved in taxes and what that actually meant for me. So with that being said, thanks for joining us for this episode. Check it out. And also book a call with Jeff and his team to save on some taxes with those properties you're holding. We'll see you next time. This is Money School Podcast signing off. Thanks for joining.